Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today we are talking about Genius Sports, which just released their earnings. Earnings were initially a hit. The stock was up like 14% right before market open. Then it kind of nosedived to basically nothing and is now down for the day as of August 7th. I'm recording this on August 8th, right before market opens. Pre-market, there's also some negative price action, so I'm going to look into why that happened and kind of revisit the stock that I looked at last about a year ago. So the stock has done very well since then, maybe about 70% up since the date of my video, which was somewhere in this range, somewhere where it was up a little bit after a decent earnings. The stock kind of meandered for a while there, but then some additional solid earnings sent it up in the last couple of months, in addition to the fact that the stock market on the growth side has been on an absolute tear. So we'll see what is going on with this company and why the stock is up in the last couple of months and where it goes from here. So, as a reminder, guys, this video is for entertainment purposes only. So, please do your own due diligence before you invest and talk to a financial advisor. First, let's look at some of the news that has happened since then. First, maybe 2 months ago, they extended their partnership with one of their two biggest partners, Football Data Co., which has all of the data for the EPL, the English Football League, and the Scottish Professional Football League. This runs through the conclusion of the 24-25 season. Always good to get that extended. On top of that, they also announced an extension for one of their bigger partners, the NFL, and that deal runs through the end of the 27-28 season. So initially, when they signed this deal, they had a deal that ran through, I want to say 24-25 with options to renew the 25-26 and the 26-27 season. So now the NFL has picked up those options and added an additional season on top of that. Initially, that deal had come with, I believe, 18 million warrants to start, which was kind of a problem for some investors. They thought maybe Genius Sports overpaid a little bit, and we'll talk about what this new extension means in that front. And in addition to that, that extension came with 4 million in additional warrants, so potentially more dilution. On the earnings call yesterday, they actually announced that, hey, we're not actually giving the NFL those warrants anymore. They didn't pick up that deal. Instead, what they are going to do is exchange those warrants for additional cash considerations in the form of data rights. So we'll look at what that means and why that's likely one of the reasons that stock sold off after the market came to know that aspect of the deal. So let's look at the earnings themselves. We won't go into too many details. If you want to know more about what Genius Sports does, look at my other videos. But essentially, they are the intermediary between the leagues and the betting websites. They provide all of the data that the betting websites use, real-time data, in order to make their products work. They do a lot of other things via their Second Spectrum business. They do a lot of AI-powered technology, tracking, etc. It's essentially very much a data and technology focused business that they acquired when they initially went public via their SPAC. I think that was a great addition. And they also do some advertising with sports leagues and more so non-sports league customers now. So overall, earnings were solid. Revenue again was ahead of guidance, representing about 22% year over year growth. So decent growth here. Their EBITDA is growing as well. Decent EBITDA margin. One thing to note with some of these companies that are off of a SPAC or freshly growing, EBITDA doesn't really mean much yet. Right now, yeah, they're showing positive EBITDA, but they're still losing money technically. They're not cash flow positive. So yes, their EBITDA is quadrupling year over year, but if you're still burning cash, you're still burning cash. The balance sheet is still pretty good though, because when they went public via SPAC, they did get the majority of the money from that SPAC. That was still when SPACs were pretty hot. The stock really came down since then. When I bought this stock, it was in that $2 to $3 to $4 range. Those were the majority of my purchases. And that was after kind of the SPAC apocalypse happened, where a lot of those deals were suddenly way overpriced as the market uh, transitioned to a risk off approach. And now that it's coming back into a more of a risk on approach again, these stocks are doing well again. But if you're an investor at SPAC time or even after, if you kind of go back to this price chart, the stock was, in that $20 range for a while. So if you were an investor at $10 before this went public, before this actually became Genius Sports, or after, you're still way in the red, even though it's up, almost 100% in the last couple of months. So interesting investment opportunity here. We'll talk about whether I'm still buying right now, but I mean, the answer to that is no at the moment. But I am holding, and I think this is an excellent company from the perspective of being the picks and shovels plays of the betting space, which is growing rather rapidly in the United States right now and has done pretty well overseas and in international spaces. And since these guys have the partnerships with the NFL, which is one of the bigger bettors, or probably the biggest bettor in the United States domestically, and then also the Football Data Co., which does really well here and overseas. They're in a good position, and they're essentially in a duopoly with another company called Sports Radar, which I also own, that has a lot of the same data sets for other leagues. Like, for example, these guys have the NFL, the EFL, etc. Sports Radar has the NBA, the NHL, etc. Even though Genius Sports may have relationships with some of those leagues as well through some of these other partnerships. Like, for example, a lot of the analytics that the NBA uses come from Second Spectrum. So, as I talked about, these guys extended those partnerships with the NFL, Football Data Co. Within those partnerships, they expanded some of the partnerships with the addition of Sports Radar technology, etc. Sports Radar, Second Spectrum technology, rather. Sorry about that. With the EPL and the English Football League. They're expanding their media customer base, like I talked. They also have a little advertising business that is growing at a decent clip. It's still a small part of their business, but it's growing. And they're using some brand sponsors that are outside of the sports space as well. And just like they did with the last earnings, they are continuing to raise their revenue guidance for 2023, which is a good sign, up from 391 as of two earnings ago, 400 million as of the last quarter, and now it's up to 410 million. So they are essentially somewhat conservative in their earnings guidance, but they're doing well to beat that every quarter. And what's nice about this company is that when revenue goes up, their bottom line often goes up alongside, because there isn't a ton of incremental cost to what they do. For example, they already have the rights to the NFL if another state legalizes gambling, and they have partnerships with companies that are offering gambling, like DraftKings, whatever, in that state. A lot of that additional incremental dollars flow through to the bottom line, right? It's not a lot of additional cost. There isn't a lot of setup for them, because they're just providing data to DraftKings that they're already doing in other states. So that's the nice thing about the expansion of gambling in the United States. And as more and more states get added to that pool, their bottom line is going to grow, which is why their EBITDA margin has gone up from 5% in 2022 to 13% in 2023. And as they talk about from a future perspective, their goal in the long term is to be at about 30+% EBITDA margin. And EBITDA margin is whatever. All I care about as an investor for the most part is how does that flow through to the bottom line? What is the conversion of that EBITDA margin to your cash flow? And right now it's nothing. They are not making any positive free cash flow. However, as they've said in the past, they are starting to see some of that and expect to be positive free cash flow in the beginning of the second half of 2023. So potentially as early as the next earnings, you will see positive free cash flow. Once they start generating free cash flow, this is potentially really when this business starts to pick up as a good investment, because they will be able to reinvest organically. They haven't really had a lot of issues with that up to now, but they have gone from a couple hundred million in balance sheet cash. If you look at their balance sheet, on a quarterly basis when they went public, I want to say they were somewhere close to 300 million in cash and cash equivalents. They're down to about, 90 million right now, um, which is obviously a lot lower. And if this were to continue, if they were cash flow negative for the next couple of quarters and burning, let's say, 10 to 20 million in cash per quarter, that could be a problem from a long-term investment perspective. However, if you look at their projections, the expectations are they're going to be cash flow positive in the second half of this year. They're also going to be cash flow positive going into 2024 and beyond. They're likely not going to have to raise money. They're likely not going to have to go into debt anytime soon, unless they want to use additional funds for some opportunity that they deem is accretive to earnings or growth or whatever. In general, I like management teams that do make investments that pay off, and I think this company has done a good job of that. I think Second Spectrum acquiring that was an absolutely fantastic move early on. I think that's paying dividends in their results right now and going forward. When you talk about AI, when you talk about data analytics, in relation to sports, I think Second Spectrum is one of the best players there. And I think that has a lot of opportunities for this company as a whole alongside their other business lines. So, as I talked about, they extended those rights agreements with key partners. They added some additional things. For example, on the NFL side, they have the exclusive rights to distribute, watch, and bet live video feeds to US sports books. I'm not a big bettor, but I'm pretty sure that's just, you can actually watch the game on the sports book page and make live bets while you do that. And that's important because live in-game bets are where Genius Sports makes more money than out-of-game bets. They make something like 5% plus from every in-game bet in terms of the amount of money they get from the bottom line. And then versus maybe 1.5% on out-of-game bets, so pre-game betting, simply because they have to provide live data and they can negotiate better contracts for that live data that happens in game. So another thing to think about as Second Spectrum grows, it's what does that do for their growth strategy, right? So a couple of things to mention. Right now, a lot of this data is collected manually. They are providing data to sportsbooks, but they have to actually have people at games work with statisticians, do it all manually, which costs a lot of money and takes a lot of time. Whereas in the future, they can do a lot of that stuff automatically with computer vision, which saves a lot of money, makes it a lot faster, makes it a lot more efficient. Sucks for people who are employed right now, obviously, but from a business perspective, that's a good thing for investors. And there's a lot of other things in terms of integrating brand sponsorships on live sport broadcasts. If you ever watched the NFL, you probably heard of RomoVision. That is a Second Spectrum product. If you ever watched the NBA, they have, or I think even the NFL does this, might be the NFL or the NBA. There's a slime vision thing where they actually do silly things for kids where they drop slimes on players while they play. Obviously, not in real life, but with augmented reality type stuff. They can put data on the blacktop when games are played and do a lot of other cool stuff with augmented reality when it comes to sports broadcasts or live betting or whatever. So it's just a lot of innovative stuff that you can watch online that will really potentially make the next generation sports a lot more interactive and a lot more watchable. Could be a lot more annoying too, depending on how busy they make these things, but in general, they do a pretty good job of using their technology to add assets for these leagues that they work with. And if they are adding value, it'll make it easier for them to renew these contracts, because that is one of the negative parts of this business. At the end of the day, they are very dependent on the leagues that they work with, and we'll talk about that in a second. But the rights deals, the deals that they make with the NFL or Football Data Co. or the NBA or the NHL or whatever, they are very dependent on those leagues. And the league can just say, well, I'll just go to SportsRadar. Maybe they'll give me a better deal. So there is a competitive landscape there. They often have to pay a lot of money. one of the things that caused the stock to drop off. Even though people loved the NFL deal, they didn't love the fact that now the NFL basically owns 8% of the business. They diluted themselves quite a bit on top of paying data rights fees to the NFL. And based on what we are seeing now, that's going to become an issue in the future as well, in terms of how much are they actually paying for data rights and what does that mean for their future. Won't go into details here, but they are starting to grow a decent media business here for brand name customers, where they work with them to kind of manage sports centric digital advertising for a broad range of customers. And again, as we look at the data, betting is still the majority of their business, but as we look at media, it's getting up there, it's growing. Sports tech is getting up there, it's growing. And the nice thing about this revenue is a lot of it flows down to the bottom line and will help them grow their free cash flow positivity into 2023 and beyond. So obviously, it's pretty decent growth here. 341 million to 410 million as of current guidance, potentially goes up even more. Football season starts soon. That's going to be a big boon for them. EBITDA margin is growing right now, not translating into positive free cash flow, but we will see that in the future. And then as we look at the full year, again, betting is still their biggest part of the business, but media, tech, and services are growing, and then sports tech is also growing at a pretty decent clip. So pretty interesting business here. I still like it very much. I'm still an investor, but there are a few things that worry me, and I think there's a few things that worry investors. And the biggest part of this worry is how much are they paying for these data rights? You know, one of the things I talked about already is how much did they pay for the NFL deal when they signed it? Again, giving up 8% of your company, an additional 4 million in warrants, which is potentially worth about 30 million at today's prices. That's a decent amount on top of the data rights, right? You're diluting your investors to do that, to sign these deals. And at the end of the day, is there a risk that some of these leagues will bring a lot of that data in-house? Because why let another partner make a lot of this money, make money off your partnership if you can just bring a lot of it in-house? And that hasn't happened yet, but it's always a threat, especially with a league like the NFL, which is massive, which has a lot of tech inside their space as well. But we'll see how that goes. Another part of this is that when the deal was announced, it wasn't very clear what, if any, dilution was happening with that. Yesterday on the earnings call, or 2 days ago, whenever that was, they basically said, well, we're not diluting anymore. In fact, they're not picking up the warrants that we originally agreed to when this deal was signed and the extension was discussed. So those 4 million warrants are gone. We're not diluting any further. And we feel like it's a good deal for investors because we're not going to dilute them, but instead we'll pay the NFL cash considerations. So what does that mean? Well, if you dig around the 6K here, you can kind of see what that means somewhat, because there's multiple deals in here. There might be other deals beyond the NFL. But as of the previous quarter, their sports rights agreements, which is the minimum commitments they have under those license agreements, which includes the NFL, includes Football Data Co., but also other agreements that they may have, was about $350 million until 2027 plus. The majority of that, kind of being in the in years and not the out years, because those deals hadn't been renewed yet. If you remove 2023, which was remaining, it's about $250 million, right? So as we look at the sports data rights based on Q1, it's about $250 million for 2024 onwards. Then, since then, the Football Data Co. deal was signed through 2025. The NFL deal was signed through 2027, 2028. And that 350 million, 250 million, excluding 2023, suddenly jumps up to 832 million, right? So that is a big increase if you exclude 2023, because obviously you're removing quarters from there. That becomes 750 million. So you're going from 250 million in projected minimum commitments from 2024 onwards to 750 million from in Q2 for 2024 onwards. Again, I'm removing 2023 to make it comparable for 2024 onwards. So that's a $500 million increase in how much they actually owe in future commitments. And obviously it's not comparable because this doesn't include data for 25, 26, and 27 for the NFL, but you can kind of see how much they're paying in terms of what they used to pay. So for 2024, for example, they were expecting to pay about 138 million in data rights, and that would include the NFL, probably not include Football Data Co., or at least part of that, because 24-25 deal was just signed. That went up to 176 million. That's a big jump. If you look at 25, again, it's about 150, 160, 170. So you're essentially paying about 160, 170 million dollars a year in data rights fees. How much of that is from the NFL? How much of that is from Football Data Co? How much of that is for other leagues that they may have agreements with? It is tough to tell, but obviously, so for example, 26 and 27, this doesn't include Football Data Co., but it does include the NFL, right? So that went up from 20 million to 160 million. So 140 million of additional data rights were added. I would have to assume that a good portion of that is the NFL. Same with 2027, went from 13 to about 175. So a pretty sizable increase there. If you look at 2024, again, which over here included the NFL, probably didn't include part of Football Data Co. It seems like it's going up a little bit at least, right? So the NFL here probably, let's say, it's hard to make assumptions here, but it's certainly going up a little bit. Or at the very least, it's going up a bit. So the idea that they're making out by not taking those warrants, but instead taking cash, and that's a good deal for investors, it seems a bit hard to swallow given the numbers, given the commitments that they're making to these contracts. You can actually go back to Q4 2022, which should have rights for 2023. If we can find them, which should include both Football Data Co. and data rights. Let's see if I can find this. Data license. Nope, can't find it. Let's try this. Data license. Okay, so yeah, so you can kind of see in 2023. So this would be a full year, right? This would include the NFL. This would include the current deal for the NFL at least, and the current deal for Football Data Co. It's about $114 million in future commitments. Now, these are minimum commitments. Potentially more states have been added, more items have been added to their deals. But at the end of the day, they went from about 114 million in minimum commitments for 2023, which includes those deals. And if you look at what those deals are for, let's say, 26 and 27, it's 161 and 175 respectively. And that doesn't include Football Data Co. for 2027, for example. So you can clearly see that the rate costs are inflating by quite a bit. 2023 was 114, 2027 is 175. That's, $50+ million difference. Right costs are going up. That is a risk for investors. That is why the stock is down in the last day or two, even though the earnings are pretty solid, even though the free cash flow positivity is going to be there. Now, the good thing about that is that it seems like this isn't impacting their future projections, right? Their rights costs are going up. That is a cost of doing business. That hasn't changed, whether it's issuing dilution or giving the leagues that they work with cash rights upfront. Their EBITDA margin targets are still 30% plus in the long run. They are still saying they are going to be cash flow positive by the second half of 2023. They're going to be cash flow positive in 2024. And that is a good thing, that it seems like they are accounting for these costs within their business plan. Potentially, this is going to impact their long-term margins negatively, more so than it would have if these rights weren't renegotiated. But that is the reality of this business. This is going to be a problem for both Genius Sports and Sports Radar, in that their costs to doing business with these leagues is going to keep going up because these leagues have the rights to this data, and Genius Sports is very dependent on this data. So they're going to pay them as much as they possibly can, and the leagues are going to squeeze them and squeeze their margins. That is just the reality. However, they can also use that data to get better deals from the sports books that they're working with, right? If the NFL is charging you more money for the rights that you're getting from them, you're going to have to charge the sports books a bit more money because they need those rights anyway, right? They need that data. So at the end of the day, maybe this isn't a huge deal. Maybe it's being a bit overblown, but it does concern me a little bit in how much, strength these leagues have. What's going to happen to Genius Sports if they ever lose any of these deals, if they go to Sports Radar, if they go to somebody else, if they go internally, right? The leagues have the capacity probably to take some of this stuff internally in the long run. Maybe they won't. Maybe the fact that the NFL is, almost a 10% owner of Genius Sports will align them with the company for the long run. Obviously, the NFL is not going to give this data up for free, but maybe that was a good thing. Maybe that was a good long-term strategy from Genius Sports to give up some equity in exchange for a long-term partnership. However, the NFL is still obviously charging them quite a bit because these rights are costing them quite a bit more. And again, the fact that this is going from 250 to 750 million, it might be like, oh, wow, that's so much money. But remember, it's not comparable, right? This did not have a deal for the NFL for a good portion, right? No deal of for the NFL for part of 25, for part of 20, for all of 26, for all of 27. No deal for the Football Data Co for part of 24, for all of 25, stuff like that. So obviously this was going to go up just for that basis alone, but it does seem like the rights are inflating at a pretty decent clip because you went from 114 million in 23 for both of those to 170 million for just the NFL alongside some of the other leagues that they may already have deals with. As far as pricing here, I think Genius Sports is priced at about 1.4 billion in enterprise value. As you look at the out years, you're talking about some cash flow positivity going into 2024. It's not going to be a lot though, right? You're talking about maybe a cash flow yield of 1.5%. But as you look into 25, as you look into 26, if they can keep growing the revenue, and I think the path to growth is there simply because gambling is going to be legalized in more and more states, and that's really where Genius Sports wins. As it gets legalized more in the United States, United States gambling is a higher margin form of business. It just is in every industry. The United States is better as a business landscape for almost every other country in the world in terms of the margins that companies can garner from a specific country. And the beautiful thing about Genius Sports business is that a lot of that additional growth is just going to be incremental, not only to their revenue, but a lot of it is going to float down to their EBITDA, to their EPS, to their free cash flow. And that's important because that is going to help this stock do well for you as an investor. And I think, do I love it at this price point? If I look at the potential for 82 million in free cash flow for 2025, that's about 4% free cash flow yield or something like that based on today's prices. It's not amazing, but it's pretty decent, right? I don't hate it, but I don't love it so much that I would start buying this stock hand over fist right now, especially with the uncertainty, the unknowns around rights costs and what they mean in the future. Again, the Football Data Co deal is only signed through 24-25. What happens after that? The NFL is locked in for a while, but certainly at an expensive price point. If you look at the valuation here in terms of how it fares against Sports Radar, which is its main competitor, it's kind of in line. Maybe it's a slightly better deal, slightly less expensive on a enterprise value over revenue side, right on top on the EBITDA side. Obviously, Sports Radar is actually making money right now. It is generating free cash flow right now. It is a bigger business. But I think Genius Sports probably has a bit more opportunity to grow from where it is today. simply because it is going to get into the positive income territory. It is going to get into the positive free cash flow territory pretty soon. It's just a matter of how they do after that. And I already hold a pretty sizable position in Genius Sports. It's probably my third largest holding. However, like I said, I was buying in that $2 to $3 to $4 range, and at 7.19, I'm in a hold spot, right? Because I like this company, I like what they're doing. I certainly don't have any plans to sell, but I do think there's some real concerns around, well, how much are they actually paying for the rights? It seems like it's quite a bit. How is that going to impact their free cash flow? I think the expectations, maybe these estimates haven't really adjusted down to what they really will be, as they're paying quite a bit more than they have in the past for the rights that they have. And maybe they can make up some of that cost in terms of renegotiating contracts on the sportsbook side in terms of getting better deals for in-play and out-of-play betting. But right now, that's still an unknown. And then again, what does it mean when they come to blows with some of these other leagues for renegotiations? And obviously, the NFL is the elephant in the room. It's one of the biggest leagues in the world, certainly in the United States. If you want growth in the United States, the NFL is where it is. And having that deal is an amazing thing, but is it going to cost too much? I do like the idea of not diluting any further in terms of not issuing those warrants to the NFL, but I also like the idea of having a carrot to keep them there more as well, right? The fact that they're now paying them more money doesn't really do anything for me. It might as well dilute on that front, give the NFL a bit more ownership stake, make them less likely to leave versus paying them more money, because anybody can do that, right? You can get more money from Sports Radar as well. And if the NFL ever leaves Genius Sports, they're in a bit of a pickle. Not that they don't make any money from other leagues and other things, because the NFL is still a very small part of their revenue, right? Their domestic revenue is not a huge percentage of their overall growth. But, certainly some risks there. One thing to also remember is that Genius Sports is a company that is based in Great Britain, so everything they do is based on the British pound. So there's going to be some currency risk in there as well. I think in the recent months that's been favorable, but it could certainly change depending on what happens with the British pound in relation to the US dollar and in relation to other currencies that they do business in. Right now, I do think Genius Sports is a good stock, but I already own too much, so I will not be buying more. However, if this little price correction were to continue and this thing were to drop back into that, $5 range, $4 to $5 range that it was just a couple months ago, it's not unheard of rather, that a stock reduces in price that quickly because it rose that quickly. Again, we are in a very erratic market right now. We are back on a risk-on perspective, and this stock has done well in that sort of marketplace. But in a risk-off marketplace, this stock will again do poorly. So if I'm sitting here a couple months from now doing another video with this stock at 350, I'd be like, well, now I'm buying, but I'm also not surprised that it's there. On the same front, I also am aware that a company that is finally getting into cash flow positivity and actually starting to make money, and not priced at an egregious level given how much it's growing and how much of that growth might flow down to the bottom line, it could go either way. So I know that's not very definitive, but stocks are never definitive. I just like to look at these businesses as an all-encompassing entity and kind of see whether I like what they're doing, whether they're making the right moves, whether there's risks involved, and talk about those risks. But in general, I think Genius Sports is a great company, an interesting business model. I think if you're into gambling and gambling stocks, this is one of the better plays still, because you are going to do well if gambling does well, and not be limited too much by the risks that can come with gambling stocks, poor risk practices, etc. At the end of the day, Genius Sports will make money no matter what happens to the various gambling websites, the various sports books. Others will rise and come, but Genius Sports is the one that is providing them with that data. It is the picks and shovels play of the gambling boom. And a lot of those sports books are not making money yet and probably won't be for quite some time. Some of them are starting to get to profitability, depending on the months. But I think the fact that Genius is going to benefit from all of their investments, from all of their spending, is a good thing. And as more states come online in the United States, as they sign deals with more leagues, as they expand their partnerships with the leagues they're already in, implementing their second spectrum technology and working with other brand partners to grow their media advertising business, I think this is going to be a good long-term investment that will likely have a lot of short-term volatility. But as I look at this stock, 10 years out, the main risks are going to be data rights costs and the risk of losing some of these data right deals to other competitors, whether it's Sports Radar or anything else that comes around, or those leagues taking that stuff in internally. However, for now, I think those risks are relatively minimal because Genius Sports provides a lot of other things that help the leagues do well. And as long as that continues to be the case, they are incentivized to continue renegotiating and renewing with Genius Sports. And that's always a good thing. So that's all I have to say. Great company, some risks, price is decent, not amazing. If it drops a couple more dollars, I will be increasing my position. But for now, I'm happy to hold the large position I already have. So guys, let me know what you guys think about Genius Sports, whether you are an investor at this price, and what you guys think about this video. And let me know if you want me to look at any other stocks. Thanks for watching. As always, this is for entertainment purposes only. Please do your own due diligence and talk to a qualified financial advisor. If you have any questions, let me know, and have a good day.